Well, futures searching for direction after the Nasdaq notched a fresh record high. Joining me now, Brent Schutte, Northwestern Mutual Wealth Management Company CIO. So, Brent, as investors are weighing what to pay attention to, they seem to be looking past tariffs largely. So then you've got earnings and you've got the Fed. Which should investors be more focused on right now?
All the above. I mean, I think investors are just looking past everything that's out there and judging that nothing is going to upset the apple cart, which I'm not for sure is going to occur. Look, we've only been with tariffs for 3 months, pretty much, and we don't know yet if they're going to filter through into higher inflation or a slower economy. I think there are risks on both sides of the equation, as well as risk on the earnings side. And that's where I think investors need to pump the brakes just a bit and make sure that they're following their strategic asset allocation and staying true to their financial plan.
And what to you, okay, so if we're paying attention to everything, which do you think is the potential biggest risk here?
Look, I think the economy has shown signs of weakening. If you look at the labor market, yes, it's remained resilient. But for the past 3 months in the BLS Labor Department report, you've seen less than 50% of the industry is actually hiring, which historically has been a warning sign. You've seen continuing claims tick up. On the consumer spending side, you've had 0.5% quarter over quarter growth in consumer spending in Q1. And the last 2 quarters have been negative 0.3 and positive 0.1. This is where I think you're seeing signs that the economy is slowing down. I think consumers or investors are thinking it's going to speed back up. And that's where I think there are still risks to that equation, especially as we continue to find more and more about tariffs and what direction they're heading, which I don't think we have certainty yet.
And Brent, it's interesting because we've had a number of strategists come on the program recently and say they view the recent tax and spending bill as stimulative, right? They look at things like some of the tax changes for CapEx by companies, and they seem to think that maybe that could mitigate some of the weakness here. How are you thinking about that?
It certainly could. I guess the question out there is which side overwhelms which and which isn't priced into the market. And at the S&P 500 trading at 24.5 times trailing 12-month earnings and 23 times forward 12-month earnings expected to grow 7% appears a bit optimistic to me. The good news is there are opportunities in other places, and I was heartened as I came on the show. You were talking about some of the older school companies that I grew up with, Kellogg, Delta, things of that nature, not just tech stocks. This is where I think there are opportunities for investors to broaden their horizons and think about small cap stocks, which trade at the second lowest valuation relative to large cap stocks in the 31 years that I've done this. The other time was June of 2000. I think we're all ignoring that international stocks are up around 20% year to date. And I think that's going to continue into the future because I do think the administration would like to see the dollar lower, which serves as a tailwind to U.S. dollar-based investors' investments in international areas. And so my big message to investors is to not just concentrate in those parts of the market that have done well the past few years. I do think there is a broadening that's going to occur one way or the other. And that's where I think there are opportunities in other places that just haven't worked as well recently.
Brent, let me ask you about small caps specifically, right? Because people have been, or certain investors certainly have been touting small caps for a while here. They haven't worked, right? And it seems like perhaps it's at least somewhat contingent on rates coming down. Do you think that's still the case? Do you think rates need to come down in order for small caps to work?
I think there are 2 things here. One, I mentioned June of 2000. That was before a recession, so rates did come down a little bit during that time period. That's typically what resets the cycle. It doesn't have to be that way. The initial shock of interest rates is just that, a shock. We've had the same level of interest rates for the past couple of years, and so now companies are adapting to that. There are also positive things in that one big, beautiful bill, such as deregulation, such as lower tax rates, that will actually probably serve as some sort of a stimulus to small cap stocks. And so to me, I go back to valuation. I talk about that. People don't pay attention to that today, but I think they will in the future. At least they have historically. And that's where I think anyone with a time horizon more than the next 3 minutes should think about owning small cap stocks for the next 3 to 5 to 7 years, because I do think you're in for a cycle of different market leadership. And that is what historically has happened. And I think it will happen once again.
Brent, we're going into earnings season, of course. And for those of us who probably are holding stocks more than the next 3 minutes, what do you think is the key question that investors need to be asking when they're trying to decide, what companies to look at as they're listening to and reading all the earnings news?
I think it's going to be forward guidance, and I know that's kind of an easy answer, but I think people are going to want to know what's the impact of these tariffs on each individual company, because that's where I think the question is going forward. The other thing, I think people have paid attention to earnings revisions only. That's been a powerful driver of stocks for the past few years. at some point, people are going to start thinking about what they're paying for those earnings revisions. And so you have some large cap stocks outside of technology that trade at 40 to 60 times forward earnings. This makes no sense to a person who's done this for 31 years, especially in areas that don't grow that fast. It reminds me a lot of the late 1990s in many cases, and that's where I just think you need to think about things that have a margin of safety. You need to think about valuation a bit more. You need to think about changing macroeconomic headwinds going forward, which may favor international stocks and even small and mid-cap stocks.
A plea to go back to the basics. I like it. Brent, thanks so much. It's good to see you.
We see you too.
Julian, it's always great to see you. So you note here, Julian, how the market has been a roller coaster. I think most people would agree with that, Julian. That seems fair. You provide some history here. You ask, what happens when that roller coaster returns to the top of the hill as it did in late June? What is the answer to that question, Julian? What did you tell clients?
So the answer is that if you look out 12 and 18 months later, the market invariably continues to rise. That's the very good news. The average is 26%. The news that I think particularly now, particularly sort of as you head in towards seasonality that starts to be less favorable in August and of course September, we don't even need to mention September, at these valuations, is that continued bull run comes with drawdowns on the order of 7.5% to 15%. And from where we sit and where we think about the likely impact of earnings, our view is that you are really sort of in the zone where there could be a potential pullback.
So given that history, given that backdrop, Julian, what are you telling clients in terms of how they should be positioned here?
So again, this is one of these ones where the advice that you render is completely dependent on how you manage your own financial position. Long-term investors, we're actually telling them to go ahead and enjoy their summer vacation, try and spend as much time in the mountains or the beach as they can. Because frankly, and if you think about it, and if you think about that return to the top of the roller coaster, if you had been ignoring the news, the headlines, and the volatility, it would have been a Rip Van Winkle type of situation where you woke up and essentially nothing happened. And here we are. There is no recession in sight. There is reasonable growth, but again, you do have high valuations. For those that are more active investors, our view is you want to add, and it's good that you've got Amy on the program this afternoon, is that you want to add an element of optionality to your portfolio. Because frankly, if we're wrong in our view of a pullback, it's likely to be the reverse scenario, sort of a 1999 FOMO type melt up. And in that case, we like the concept of optionality in the portfolio. If you're using stocks, you want to have low valuation stocks, low multiples, and strong earnings revision type names across sectors. Think about it. They tend to cushion the downside. And in fact, if the capital market cycle heats up, those are the type of the names that could be acquisition targets. Conversely, if you use options, we think triple Q option volatility is extremely attractive here. And at these levels, you can actually afford to hedge for both the drawdown potential that we see and the melt-up potential if we're in fact not right about that view.
If you saw the pullback, Julian, how would you expect investors to react? They dive back in, they buy that dip?
Well, I think, and again, credit to the retail investor who has consistently learned the lessons since 2020 of buying the dip. And I think one of the most unusual aspects of this, frankly, bear market that we had from the February peak to the April trough is that the retail investor was much more patient and actually bought the weakness, whereas institutions really were in risk reduction mode. So we do think that a dip would be bought. And from our point of view, consistent with our work, 7.5% to 15% downside seems right because frankly, we don't see the potential for a recession shaping up here. And so, drawdowns of, on the order of 20% or more just really don't make sense to us at this point.
Amy, just to bring you in here, because we were talking about this issue earlier, you would argue, Amy, correct me if I'm wrong, if we saw that dip, you would expect folks to move in.
Yeah, exactly. It's interesting because, like Julian said, there's really been this volatility regime post-COVID, which has looked very different than the pre-COVID regime. It's much been more about the right tail. So essentially the idea that you have FOMO and a chase to the upside, you don't want to be underweight, you have to jump in the pool. All that has made that fat tail not necessarily about downside, but about missing out if we do get that big bump up, for example, like post-Liberation Day.
Julian, I have to ask you while I have you, NVIDIA hits $4 trillion today. Remarkable milestone for that company, for CEO Jensen Huang. What are you advising clients about just the mega AI trade and theme here, Julian? I think when most people think about AI names, they are thinking NVIDIA, they're thinking Microsoft and Broadcom, which have had these just tremendous runs, Julian.
So we at Evercore ISI launched coverage with very comprehensively. Really, it's amazing. Over 2 years ago now, with a very positive structural view on AI. And so if you think about all the sort of potholes in the road, I'm thinking DeepSeek and others over the last several years, the theme has been able to overcome all of it. And to us, the proof of the pudding is the fact that those sectors that had lagged into the downturn, and if you think about it, NVIDIA really spent the better part of a year moving sideways. And to your point earlier, it gets cheaper on a multiple basis because the stock is catching up to where the earnings are going. We think, those structural AI leaders, the enablers, continue to be attractive. But what we've seen that's different this year is that the adoption amongst corporate America, not just for cutting costs, but also for figuring out how to enhance revenue, is occurring across industries. And the companies, we call them the enablers, the adapters, and the adopters, that are going to excel in creating a competitive moat by use of AI are going to continue to take market share and, in our view, increase share price.
Final question, Julian. NVIDIA was making headlines today. So was President Trump, right? Because he continues firing off these tariff letters, Julian. What's interesting is how the market responds, which is with a shrug, Julian. I'm just looking at the popular averages, green everywhere today. And I'm just curious what you make of that market response.
No question. And it is a bit of a head scratcher. I would say that, though, today in particular, if you look at those letters sent, they were smaller countries, not really sort of the biggies like the EU or Canada or Mexico or India. So those are presumably still in the crosshairs of deals getting struck, potentially, of course, before August 1st. And I do think that, again, the behavior of the overreaction into April with a tariff regime that actually is not that far away from where conceptually we could land at this point is probably almost inversely proportional to the yawn that we're seeing now. And we would argue, again, given how far the market has come, that yawn may be a bit premature.
Julian, it is always a pleasure to have you on the show. Thank you for joining us.
Thank you.